September 23, 1998. The Federal Reserve Bank of New York is summoning the titans of global finance into an emergency session. They are not here to discuss interest rates or inflation. They are here because a private investment firm is about to detonate, threatening to take the entire global system down with it. How could a fund run by the smartest minds on Wall Street, including Nobel laureates, achieve this level of catastrophic failure? The answer lies in the chilling realization that the government stepped in, bypassing every normal rule of the market, to socialize the risk of immense private greed. The story begins in the spring of 1994. Long-term capital management, or LTCM, launches with initial capital hovering around $1.3 billion. The founders are legends, former Treasury bond trader heroes and academic giants who believe they have cracked the code of the universe using mathematics. They see patterns others miss, and for a while they are gods of the bond market, trading everything from equity index futures to complex derivatives backed by U.S. Treasury securities and G7 sovereign debt. The first few years are golden, confirming their belief in their own models. But success breeds arrogance, and arrogance demands scale. By January 1, 1998, the balance sheet leverage ratio is already north of 25-1, $25 borrowed for every dollar of capital invested. The underlying assets are safe, the models assure them. They are merely exploiting tiny, temporary mispricings in highly liquid debt. But the borrowed money amplifies everything. By late August, the SEC suspects the leverage has ballooned to 50-1. The tension begins to crack the facade. Suddenly, the tiny mispricings they bet on don't correct. They widen. Markets, driven by external shocks, like the Russian default that same month, begin moving in ways the mathematical certainty of their models declared statistically impossible. The air in the LTCM offices grows cold. The phone calls start frantic. The fund's value is hemorrhaging money faster than they can liquidate positions. On September 18, 1998, LTCM executives finally break their silence, contacting William McDonough, the president of the Federal Reserve Bank of New York. The market is holding its breath, waiting for a signal that only the Fed can give. 2 days later, a team from the New York Fed descends upon LTCM's headquarters, witnessing the unimaginable, a $100 billion portfolio dissolving into dust. The danger isn't just the loss of capital, it's the fire sale. LTCM is so deeply entangled in global derivatives that dumping their assets would trigger margin calls across the entire financial system, forcing major banks to sell their own assets at fire sale prices, causing a cascading collapse that would dwarf the instability of 1987. The Fed recognizes the threat. This isn't just a hedge fund failure, this is systemic contagion. The Fed decides that normal market mechanisms, the very forces the fund's partners claim to understand, must be suspended. The government cannot be seen directly bailing out a private, highly leveraged investment fund. The moral hazard would be unprecedented. So the Fed orchestrates a shadow intervention. They convene the largest creditors, 14 major banks and brokerage houses, and issue a stark ultimatum: form a consortium, or watch the global economy seize up. The offer presented to these titans is stunningly low. The partners, whose firm was worth nearly $4.7 billion at the start of the year, are now being told their claim is reduced to just 10% of their investment. In exchange for absorbing the risk, the consortium of banks agrees to inject $3.5 billion into LTCM. The Fed facilitates the agreement, coordinating the rescue package, ensuring that the potential losses of the few are distributed among the many. The narrative of the crisis is one of extreme leverage colliding with flawed logic. The Nobel laureates had built models based on historical volatility, assuming market correlations would remain within established norms. But the models had no mechanism for a systemic crisis of confidence. They couldn't account for the fear that gripped global markets after Russia defaulted. When they needed liquidity, the system choked. They had been using highly liquid assets like U.S. Treasuries as collateral, but when everyone needed those same assets simultaneously, liquidity vanished. The coordination was ad hoc, a desperate 11th-hour mobilization that bypassed the usual regulatory oversight. The banks invest the capital, effectively taking 90% ownership in return for saving the world from a financial meltdown caused by flawed equations. The sheer scale of the coordination, a $3.625 billion rescue fund assembled in a matter of days, reveals the true power held in that room at the New York Fed. The immediate threat is averted. the fire sale is prevented. But the precedent is set. When private entities wield risk on a systemic scale, the public safety net, the Federal Reserve, will construct a mechanism to socialize that failure. The consortium banks eventually recover, but the partners suffer substantial losses, their initial capital almost entirely wiped out. LTCM begins selling off assets over the next 2 years, liquidating in an orderly fashion, an order only achieved because the government imposed a solution that the free market itself would never have tolerated. The question remains unanswered. If the mathematical models were so sophisticated, how did the architects of modern finance miscalculate the risk of total failure? They understood risk on paper, they understood market arbitrage, but they failed to model the ultimate market force: panic. The LTCM crisis of 1998 wasn't just a cautionary tale about leverage. It was the clearest demonstration yet that in moments of ultimate crisis, the rules of capitalism bend, and the central bank becomes the ultimate insurer against the consequences of intellectual overconfidence. The system was saved, but the trust in truly independent market mechanics was permanently compromised, whispering a warning that would echo just a decade later. Video duration: 7 minutes 30 seconds. Total B-roll clips: 15. Average clip length: 5 seconds. Chapter 4. Scar. The immediate aftermath of the LTCM bailout was a period of intense, if quiet, introspection within the financial establishment. The crisis had been averted, but the solution itself, the coerced formation of the $3.6 billion private lifeboat, left deep scars on the architecture of global finance. The narrative that emerged was carefully curated. LTCM was an outlier, a group of brilliant minds who succumbed to hubris, a necessary correction in the excesses of the late 1990s bull market. But for those who sat in the mahogany-paneled rooms of the New York Fed that September, the reality was far more sobering. They had witnessed, firsthand, the fragility of a system built on complex interdependencies they barely understood. The official story minimized the extraordinary lengths to which the Fed had gone. There was no public announcement detailing the strong-arming of banks into the consortium. The language used was one of facilitation and coordination among willing partners. Yet the reality was that these major creditors had been presented with a choice between absorbing substantial, albeit shared, losses now, or facing the near certainty of a systemic breakdown later. The moral hazard, which the Fed sought so desperately to avoid by keeping the bailout off the public ledger, was inherent in the act itself. They had institutionalized the concept of too big to fail, not just for commercial banks, but for highly leveraged investment vehicles whose failure threatened the plumbing of the derivatives market. The academic partners, John Merriweather and the Nobel laureates, were forced to watch their creation dismantled. While they were shielded from total personal ruin, their previous compensation had ensured immense personal wealth. The public dismantling of their intellectual triumph was a profound humiliation. Their core assumption, that historical risk models could perfectly predict future market behavior, had been fatally undermined by a single, geopolitical shock. Russia's default on its sovereign debt, combined with the resulting flight to quality, created a correlated movement across asset classes that their equations had deemed impossible. Correlation, the cornerstone of their strategy, had spiked to 1.0 when it mattered most. This realization sent ripples through quantitative finance departments globally. If the masters of the universe using the most advanced mathematics available couldn't protect themselves, what hope did smaller firms have? For a brief period, a cautious retreat occurred. Leverage ratios within some high-flying hedge funds contracted slightly. But the deep-seated belief in mathematical superiority, the core tenet of the post-1980s financial revolution, was too ingrained to vanish completely. Instead of abandoning quantitative modeling, the focus shifted. The new imperative became, model the panic. The scars left by LTCM were not purely philosophical, they were structural. The crisis exposed the vast, opaque world of the over-the-counter OTC derivatives market. LTCM's positions, particularly in swaps and complex credit instruments, were largely invisible to regulators until the moment of collapse. Regulators accustomed to monitoring balance sheets and capital adequacy ratios of traditional banks found themselves blind to the true interconnectedness woven through these private contracts. The response, slow and bureaucratic, was the initiation of regulatory reviews aimed at increasing transparency in derivatives. But true transparency was anathema to the very participants who drove that market. Banks preferred the privacy of bilateral deals. The LTCM incident demonstrated that when risk pools within the private sector become too vast, the regulatory framework is simply too slow to adapt. The market moved faster than the legislature. The bailout itself created a secondary lingering distortion. The banks that participated in the consortium, J.P. Morgan, Goldman Sachs, Morgan Stanley, and others, were essentially subsidized in their rescue effort. The Fed had guaranteed them that their investment would be protected from the ensuing market chaos, effectively underwriting their participation. This meant that the very firms that were supposed to be competitive